Mitch Reiner, Managing Partner, Senior Investment Advisor, and proud member of the Money Matters team here at Capital Investment Advisors. We got an awesome question this week through the Money Matters questions. Question was, I'd like to know how, if, and should I carve out a portion of a 401k or IRA account to invest in things other than stocks and bonds, like real estate, for example. Can you help me with this question? Great news. We can, and I will. A lot of people ask this question, especially because oftentimes the majority of someone's assets are held inside of their tax-deferred account. So like a traditional IRA or a 401k. First, I want to say this, the Money Matters team, we believe in the power of investing in real estate. You have so many benefits of this, including having a hard asset backing your investment, the ability to borrow money and leverage your returns in the form of a mortgage, and the ability of producing long-term and consistent income in the form of rent. There are drawbacks of investing in real estate, though, including the ongoing management of a property, right? You got to get somebody out and get somebody in. You got to fix the light bulbs and the toilets, right? You got to do it all. The illiquid nature is also a drawback of an investment like this, right? You can't trade it day in and day out. You can't have immediate cash if you need it on a piece of real estate. And the typical length of time to invest before significant returns are realized is sometimes a drawback of investing in real estate. But specifically to your question about investing inside of a tax-deferred account, we would actually suggest against it most times. And there are a few reasons for this. Number one, the lack of low-cost custodial options. Most custodians don't allow for this. A custodian is like Charles Schwab or Fidelity or Vanguard, where every month you get a statement that tells you what is the value of your assets. That's not typically available when you own real estate, because how are they going to value your rental home on Jones Street every single month? There are specialized firms that do this, but they are smaller, less dependable, and typically much, much more expensive. So that's number one, lack of low-cost custodial options. Number two, poor tax benefits. If you have an asset like this inside your IRA, you may be hit with taxes on income, even though it's already in a tax-deferred account. This is not the case with a publicly traded investment. Also, things like depreciation and step up in basis that are typically very beneficial for a piece of real estate are lost inside of an IRA. So know that you can gain so much of the same benefit of real estate by looking for publicly traded investments that have similar risk and return and asset class exposure characteristics. If you're looking for medical office exposure, you can buy a REIT that's publicly traded that may give you that same type of asset class exposure. So investments like REITs may give you much of the same benefit without the challenging headache that the above investing in an IRA would create. Thank you so much for sending in your question to us here at the Money Matters team. If you ever have another question like this or any other one, please don't hesitate to send it to us. We're here all the time to answer all your questions at www.yourwealth.com. Money Matters team is here standing by.